Hello and welcome to the lecture for Chapter 4. In this chapter we're going to talk in a bit more detail about adjustments. We're going to talk about creating and issuing financial statements, and then finally talk about the closing process. So the accounting cycle is something that we go through every month and we go through every year. So just to walk through the steps in the accounting cycle. The first step at the beginning of any accounting period, again, it could be a month or it could be a year, depending upon the business and what we're doing, is we're going to analyze transactions that flow through the business. What is occurring? Who are we invoicing for services? What expenses are we incurring? What assets are we purchasing? What liabilities are we paying down? All of those things are going on really every minute of every day. And we analyze those transactions so that we can, in effect, code them so that the accounting system understands them. That coding, if I tell you I went to the bank yesterday and I paid down my loan with the bank with $1,000, that's a narrative verbal description of what just happened. I'm going to convert that into a journal entry that I can put into my accounting system to capture that transaction. So taking $1,000 into my bank and giving it to them to reduce my debt with the bank, that journal entry would be debit note payable to reduce the liability, credit cash to reduce the cash I have in the bank. Okay, so that's called recording the entry. I would do that in a journal. And then I would post that to the general ledger. So I would think of a general ledger as a binder where there's one page for every account. I would turn to the note payable page and record the debit that reduces my debt. I would turn to the cash page. I would credit cash to reduce my cash balance. So that's posting to the general ledger. We do that because I need to know my ending position in cash. I need to know my ending position with regard to that liability in order to prepare financial statements. So I need to post it so that I can look at the total impact on cash, the total impact on debt in the case of that transaction. Now, I do that for all transactions. Now, I described it kind of in a manual process. The same exact thing happens in a computer system. If I go into a computer system and I record a transaction of paying down debt, a bank transfer, that sort of thing in my accounting system, it's going to do that general entry or that general journal entry, and it's going to record that to the ledger in the background. But the same thing is happening. Once I get to the end of an accounting period, now let's say it's a month, I would prepare a trial balance once I've recorded all of the transactions for that month. That trial balance is simply a listing of all the accounts in my accounting system and what the ending balance was, debit or credit. The purpose of that trial balance is to make sure debits equal credits, that we're in balance. It's to make sure that there are not errors that were made, maybe mistakes or things that were recorded incorrectly. Maybe I have an account for office supplies and it shows a credit balance. Well, it should normally have a debit balance, and I can't have negative office supplies, so I know there's a mistake there and I would fix that. So I would make corrective entries, and I would also make adjustments. So the adjustments that we talked about in Chapter 3, I would record those adjustments, and then I would prepare another trial balance called an adjusted trial balance to make sure, did those adjustments make the changes that needed to be made? And does it now look correct? I may do multiple iterations of those steps until I finally get it right. Once I get the trial balance, the adjusted trial balance, to where I think it is correct, then I will use that listing of accounts and their balances to prepare financial statements and disseminate them to whoever should be receiving them. I'll then go back and start doing transactions for the next month. So I'll do that process every single month. When I get to the last month, say it's December as an example, then I would close the income statement accounts to retained earnings. And I'll talk about that on the last slide in this lecture. When it comes to adjustments, a couple of terms that are used I want to describe in more detail. You'll often hear the term in accounting, deferrals and accruals. And It really relates to getting expenses and revenues in the correct time period. We talked about the time period assumption in chapter 3. So I want to make sure most of my adjustments are really going to be related to getting things in the right time period. Two kind of adjustments that are made. One are adjusting entries, which relate to deferrals and accruals, and then there are corrective entries. I'm always going to have adjusting entries. I may or may not have correcting entries because I may not have made any mistakes. So a deferral is, to think of it in a different term, because you probably don't use the word deferral all the time, a more common word that means the same thing is delay. I want to delay recognition of something until the right period. So I mentioned in the last chapter, what if I pay my insurance for the upcoming year in advance? Well, I want to delay recognition of that expense. I don't want to recognize a whole year's worth of expense in January for insurance. That would make January look much worse than it really is, and all the other months look better than they really are. So I want to defer or delay recognition of that expense until later. That's how it relates to expenses. As it relates to revenue, if I talked in the last chapter about doing consulting for you and billing you in advance for receiving cash from you in advance for the next 3 months of doing this consulting work. I want to delay recognition of that revenue until I actually perform the services in later months. Excuse me. The other category of adjusting entries are accruals, and that's also a word you probably don't always use. I like to think of the word add. These are things where I need to add something to my accounting system or else it wouldn't be recognized. In terms of revenue, I might have unrecorded receivables. Say I have an agreement with you to do 3 months of consulting, and I agree that I'm not going to invoice you until the project is done. In that case, the invoice at the end of the 3 months is what would trigger an entry in the accounting system, right? It would debit accounts receivable and credit revenue. Well, I want to recognize throughout that 3-month period that I'm doing work for you and you owe me money as we go, right? If I've done a third of the work and you quit or I quit, barring contractual agreements, you owe me a third of the money. So I want to make an entry in my system each month to increase an accrued receivable and to recognize some revenue as I earn it. Okay, so if I didn't make that entry, it wouldn't happen until I cut the invoice, and that would distort things. The same thing with unrecorded payables. I may have incurred some expenses. The most common one is salaries. Let's say I have a company that I pay all my employees on the 15th of the month and the 1st of the month. Well, for the latter half of the month, my employees have all done work for me. That's an expense, and I owe them money. So again, I'm not cutting payroll until the 1st of the next month. So there's no transaction that is triggering a journal entry in the system. If I don't make an accrual, if I don't add a journal entry to my accounting system where I recognize the expense and recognize the liability, then I would not have captured that transaction, and it will distort this month. It'll make it look better than it really is, and future months look worse than they really are. So that's the difference between deferrals and accruals. One type of entry we'll need to record, one type of accrual, is interest on debt. So interest expense is incurred as we owe money over time. If I borrow money from a bank, then I don't owe interest the day I borrow the money. Time hasn't elapsed. As time goes by, I owe the bank interest and I've incurred interest expense. So the formula for determining interest expense is taking the principal, the amount you borrow, times the annual interest rate in decimal form, so 5% is 0.05, times the amount of time that has elapsed. And so we'll take a look at the number of months that have gone by and divide that by 12. And we divide it always by 12, regardless of the term of the loan. It could be a 6-month loan. We'll still divide by 12 because the interest rate is an annual interest rate. So I want to multiply it by a fraction of that year in order to get the interest for the particular period. Usually this is done at year end. It could be done monthly if there's significant debt, and it would distort things to record it all at year end. So I'll record the interest on the debt as we go. And as you can see in the entry here, I record interest expense and interest payable. So when the loan becomes due and I need to repay the principal that I borrowed plus accrued interest, I'll be paying the note payable and the interest payable. So to wipe those out. This allows us to get the expense in the right period. So we'll recognize the expense associated with 1 year in one period, the expense associated with the next year in the other period. So this is only necessary when we have debt that spans month ends or year ends. I'll also need to accrue income tax expense. And income tax expense is not, that we record on financial statements, is not necessarily the liability that is shown on our income tax return. It's called book tax. So it is what is our net income for book purposes, and it could be different for tax purposes based on depreciation, based on timing issues, those kinds of things. Tax rules are a little different than generally accepted accounting principles. So we'll look at what our net income is, record the tax on that by debiting income tax expense and income tax payable. Now, if there's a difference between book income tax payable and the actual payable on our tax return, that would generate a deferred tax asset or a deferred tax liability, which you'll cover in intermediate accounting, but you don't need to worry about it right now. We'll record depreciation. So depreciation is the allocation of the expense of wearing an asset out over its life. So we've talked about this in survey of accounting. So if I buy a truck and I'm going to drive the truck 100,000 miles a year, delivering all over the state of Washington, then maybe I'm going to wear that truck out over 3 years. So it's spreading the cost of that asset over that period of time. That is going to require the use of a contra account. And I can remind you, a contra account is an account that has a different normal balance than its neighbors. So all of our assets have a normal debit balance. They should have a debit balance. The debit side of the T account is how we increase assets. Well, we're going to have one asset account called accumulated depreciation, which is the accumulation of all the depreciation entries we've made over the years for a particular class of assets. That is going to have a credit balance. That's why it's a contra asset. It's a credit balance when all of its neighbors have a debit balance. So that contra account is going to offset the asset which is being depreciated. So I may have truck on my balance sheet, and maybe it's listed at $60,000, and I think I'm going to depreciate it over 3 years. At the end of the first year, I would have truck $60,000. That wouldn't change, and then I would have less accumulated depreciation, in that case of $20,000. So my net book value for that asset would be $40,000, and it would decrease each year until it's fully depreciated. So here is a trial balance that I wanted to show you, and some people will just do, not all companies do the adjustments like this. Sometimes they just have an unadjusted trial balance, and then they have an adjusted trial balance, two separate documents. But in this case here, it's kind of nice because it shows you, well, what was it unadjusted, what adjustments did we make, and then what ending balance does that relate to. One thing that I don't agree with the publisher that I wanted to point out is you might see it says there by cash note, cash does not change balance, it's never adjusted. I don't agree with that. When we do bank reconciliation, we'll often record adjusting journal entries associated with the bank reconciliation, recognizing non-sufficient fund deposits that customers have given us, bounce checks, recognizing service charges from the bank, things like that. So there are often adjustments related to cash. So I disagree with that. Okay, I think that's it on that. Here we've got a balance sheet. Now this is a classified, or excuse me, statement of income. This is called a classified statement of income because it has subtotals. So a unclassified income statement would just be revenues minus expenses. Here's net income, right? I wouldn't have any subtotals in there. In this case, we have a subtotal for operating expenses, a subtotal for general and administrative expenses. So we kind of give a little bit more information to a reader and don't require them to do it by hand themselves. Here we have a consolidated statement of stockholders' equity. If there is a company that has not had any stock transactions, they haven't issued shares, they haven't repurchased shares, they could then do just a statement of retained earnings. And either a statement of retained earnings or this statement of stockholders' equity is essentially a reconciliation of what were the beginning balances for these accounts, what happened during the period that changed them, and what is the new ending balance. So we'll do this because we need those ending balances to be able to do the balance sheet. We did the income statement first because I needed the net income. You can see it shown here as the third item down under the yearly activity. I needed the net income figure in order to complete this, so I had to do the income statement first. What a reader would get from looking at this is essentially, are the owners of the company putting money into the company, or are they sucking money out of the company? So it's not, of course, against the law or against good business practice for owners to take money out of the business. Of course, that's their right. But it would send a strong warning signal to you if you were going to loan a company money and it looked like the owners were taking out as much cash as they could every single period. That would send a signal that maybe that isn't the best entity to grant credit to. Next, we have a consolidated balance sheet, and in this case, it is also classified. This is just the asset section. Again, it's classified in that it's showing subtotals. In this case, also it's showing comparative figures. So the subtotals here are current assets, property, plant, and equipment, operating lease right-of-use assets. That's if we lease assets. Like say I rent a building for 10 years, I own the right to use that building for that period of time. So that's the value that's shown there that would offset the liability that I owe the landlord for the lease that I've agreed to for 10 years. And then I have intangible assets. And then the liability section, of course, if I'm showing current assets, I'm also going to show current liabilities because comparing the totals of those two is really important to make a judgment about a company's ability to pay liabilities as they come due. And then I have longer term assets. That's a separate subtotal. So again, this gives information that we need. So the closing process, that's again going to happen at year end. And we need to distinguish between two types of accounts, permanent accounts and temporary accounts. Permanent accounts are accounts that are going to keep their balance from year to year. If I own $1 million building on December 31st, I still own that $1 million building on January 1st, right? That doesn't go away, right? It should carry over from one year to the next. So balance sheet accounts are permanent accounts, okay? Temporary accounts, which would be accounts that we want to clear out at the end of every year. Say my rent is $1,000 a month. Well, every single month during the year, I want to know, well, what was it for the month and what is it year to date? I want that to accumulate. At the end of June, rent expense for the month was $1,000. Year to date, it was $6,000. So I want to keep accumulating that. At year end, the yearly balance for rent would be $12,000. Well, I don't want to record that it's $13,000 at the end of the next January, right? I want to wipe that out, wipe the slate clean so I can start with zero in the next year. So I'm going to close those temporary accounts, and I'm going to close them to retain earnings. That's how net income gets into retained earnings. So accounts with a credit balance, meaning revenue accounts for the most part, are going to be debited, and I will credit retained earnings. And accounts with debit balances like expenses are going to be credited, and I will debit retained earnings. That's how revenues pull up retained earnings. Retained earnings has a normal credit balance as part of stockholders' equity, and expenses pull down retained earnings with a debit to retained earnings. So here's a document that you can see how that's being done in a simple system. So again, you can see they're not closing out assets or liabilities or stock or additional paid in capital. They're just closing out revenue and expense accounts. And they make that entry where they debit the revenue accounts, they credit the expense accounts, and the difference between the two is going to go to retained earnings. That difference between the two should be equal to your net income for the year, right? That figure of 90 here should equal 90,000 or $90, whatever it is, on the income statement. So that's a way of kind of double checking that. So that's the last slide for this lecture. So please do the in-class practices, compare them to the solutions, and then complete the homework. And then the next step after that is to take the first exam, which I will post as well. Thank you very much. As always, please shoot me an email if you have any questions. Thank you.